Jonathan, the delightfully named Smurfit Kappa, which is in the rather mundane business of corrugated cardboard, is a company that I thought of as only recently having gotten out of bad habits of debt accumulation and over-leverage. But today I hear they've made an acquisition in all places as Brazil. What do you think?
You're right on both counts. This is a company that had a very large debt pile, largely as a function of the fact that it was taken private off the stock markets in 2002. Then it did a big deal with Kappa of Germany in 2005, and then it came back onto the market in 2007 with a sack full of debt. And along came a financial crisis, and its share price fell 75% or so. Now, since 2011, it's been paying off the debt, restructuring. Since 2012.
And it's been working.
And it's been working.
Presto, you pull the debt down to a reasonable range, the stock has a chance of going up.
The stock has been doing pretty well over the past few years. It's outperformed, in fact, most of its European rivals, companies like DS Smith, Mondi, and the Scandinavian packaging makers. And yes, it has done this deal in Brazil. It's not a large deal, about $170 million or so, to acquire two privately owned companies.
But despite the small size of the deal, the natural worry here is that it's a sign of ambition and risk appetite. And the last thing I want from my commodity company in this environment is risk appetite. I want cost control. I want discipline. I don't want adventures.
Well, you could be forgiven for thinking that. There's a newish CEO who just happens to be the grandson of the company's founder, so he has big shoes to fill. He may want to go out and make a sort of big impact and do some big deals. But this is a small step. These transactions will add maybe 1-2% a year to earnings. And the company has a self-imposed target when it comes to debt. It does not want debts to get any more than sort of 3 times EBITDA, earnings before interest, taxation, depreciation, and the rest. The thing is, though, if you go back to 2007, net debt was 3.2 times EBITDA back then, so not much above the top end of the range they're now sort of targeting. And look what happened next.
Yeah, the EBITDA collapsed. So I guess the lesson to take away from here is still a cyclical business, keep an eye on the economy, and make sure that debt discipline stays in place.
That's right, because if you look at when the markets have been rising and the company has been in recovery mode, its leverage has helped it. Its shares smashed its rivals from about March 2009 to April 2015. But in periods where the share price has been falling, it has fallen by more than those of its rivals, who coincidentally have less leverage.
Thanks, Jonathan.